This is the Consumer Price Index. It's at the highest point in 41 years. To bring it down, the Federal Reserve pushed through the biggest rate hike since 1994 in June, and is expected to keep raising rates at the fastest pace in a generation. Why is the Fed going against the slow and steady pace that they've said is best for markets and for everyday Americans? To put it simply, they've fallen behind on reining in inflation. I'm going to break down the events that got us here, explain how the Fed's past decisions and some outside factors led to its current struggle, and detail what the Fed is doing now that it acknowledges being behind on inflation. Let's get into it. To really understand how the Fed fell so far behind on inflation, you've got to understand the US central bank's history. The Federal Reserve was created in 1913 to control price stability, meaning keep inflation in check. But in 1978, Congress gave the Fed a dual mandate. Not only did they need to hold down inflation, they were also mandated to keep unemployment low. Fast forward to 2009. To combat the global financial crisis, not only did the Fed lower US interest rates to zero, they began a new strategy of pumping trillions of dollars into the economy by buying government bonds. When this idea was first proposed, many economists worried it would create massive inflation, but that didn't really happen. Well, except for asset prices. Housing prices, stock prices, and bond prices rose exponentially, but not many people complained about that. In 2017, with rates still near zero, President Donald Trump signed a massive tax cut and stimulus bill that pushed even more money into the economy and drove the unemployment rate to new historic lows. And even that didn't raise inflation. In fact, economists at the Fed started to worry that inflation was too low. In 2020, Chairman Jerome Powell decided to try something new. He called it average inflation targeting, or AIT. AIT just meant the Fed would keep interest rates low until inflation rose above its 2% target and held above it for some time, since it had been below the 2% target for some time. But AIT turned out to be pretty bad timing. AIT was introduced right before the COVID-19 pandemic caused a wave of business shutdowns. The pandemic led to the Fed pushing trillions more dollars into the economy to prop up businesses, along with trillions of dollars in stimulus from the federal government through tax cuts and direct payments to Americans. Still, the Fed insisted it would stick with inflation targeting. So as inflation readings came in above the Fed's 2% target, the Fed not only kept rates near zero, it continued pumping money into the economy. Chair Powell and the Fed said the rising prices would be transitory, and that they would fade away as supply chains returned to normal and consumers returned to their pre-pandemic buying patterns. Prices continued to rise, and the Fed continued to say that they would stop rising on their own. But they didn't. And late last year, the Fed decided to retire the word transitory. Even after doing so, the Fed continued to hold rates near zero and pump $120 billion a month into the economy. They didn't stop increasing the money supply until March of this year, when the Consumer Price Index had reached the highest in 40 years. While the Fed and the government were pumping money into the economy, increasing demand, the world experienced multiple shocks that reduced supply. A new COVID outbreak sprang up in China, shutting down major parts of the world's supply chain. The US-China trade war continued to add tariffs to US imports and upended long-standing business arrangements. And Russia invaded Ukraine, further disrupting the distribution of food and oil. Higher demand plus lower supply usually leads to higher prices. All of those things got us here, and now the Fed is trying to make up for lost time, with many of its members even saying that they are behind the curve. They started by raising interest rates the normal pace in March, then raised by double the usual rate in May. And in June, they raised rates at 3 times the normal rate. Markets are expecting an increase of that size in July. But interest rates are still more than 7 percentage points below the rate of inflation. And it's not clear how high interest rates will have to go before inflation gets back down to the Fed's target, 2%. Some have argued the Fed is making a big mistake by raising rates this fast. Only time will tell. Griselda's Benny the Butcher reminded us recently that where you are isn't where you have to be. He said, "Remember waking up being broke? I hated that feeling. My sacrifice and dedication just made a few million." That's all for now. See you next time.